Last Friday, the sell signal was triggered. Today, we saw this big gap up and we saw some selling into that strength. What's going to continue for the rest of the week? We're going to be looking at some charts today to really kind of get a good idea. Housekeeping before we do, though, I am going on a vacation for the next 7 days. I plan on posting market briefs. However, they might be at sporadic times, could be early morning before the market opens up. And if it's a really dull day, I probably won't even post. So keep that in the back of your mind. As far as all the patrons go, I'll be getting out a trade ideas video here shortly. There's a few out there, but I'm going to just kind of reiterate a few things as far as that goes. So be on the lookout for that video to come. You're watching the Daily Stock Market Brief. My name is Michael Silva. We got some important stuff to talk about today. Let's just go ahead and get right into it. All right, everybody, welcome back. We're going to start off here at the market dashboard. A couple things that I want to point out. Technology takes it on the chin again. Now, we kind of touched on this on the last weekly recap from a relative strength standpoint. Well, technology obviously got a lot weaker right here, and this is not a good sign by any means, which we'll talk a little bit more about here in detail soon. As far as strength goes, the two sectors that had the strength that we've been kind of eyeballing here from a relative standpoint is utilities and consumer staples, defensive plays, right? So people typically move to those for a risk-off type environment. Is this mean that we're seeing a new trend start? I don't know yet. But we will look at the charts of what we got and try to come to a conclusion, which we'll talk about at the end of this video. As far as all the indices go, red across the board, except for the VIX, up 17.8%. So pretty large spike there in the VIX. Relative rotation. This is where I kind of want to just reiterate once again. We've been tracking XLU and XLP, rotating from improving to heading, from bottom left to top right into the leading category. So continue to watch this. This is the same thing that took place going into September. And we all know what happened in September. We saw a big correctional move. We saw a recover, and then we saw another correctional move, a lot of chop that went on. I also included XLK and XLC down here because they make up a big percentage of the SPY, right? XLK makes around 25% of the SPY holdings. And then XLC is, I think, 11 to 13% right around there. So when you see this moving into weakening, and then you see the XLK into lagging, this is not a good sign. Let's pair that with obviously the sell signal, right? The sell signal was triggered the other day. This is continuing to drag up. I also want to mention that previous hedge fund manager or somebody who worked in the hedge fund business, Thomas Thornton, did call out the other day on Twitter too, something very similar to what I use, that put to call ratio. I look at the CPC, smooth over 10 days. He's looking at the 7-day moving average of the equity put to call ratio, and he just called out that it was diverging from the price. You can see the price of the S&P 500 moving up here, and you see the diverging moving average over here. What does that say? It says to us that, hey, careful here because there could be a rug pull pretty much at any moment. And today we saw a little bit of that weakness, but we don't know for sure if it's going to continue. Another thing that I want to point out is the lumber to gold ratio. Michael Guyad pointed out that it's reaching, let me just read it, the lumber to gold ratio is at levels not seen since 2005, just as the housing bubble was nearing its final year, 3 years before the great financial crisis. So we are back up into these just massive, massive levels. So to say that there's not some crazy bubble going on is, you're getting trapped up in the euphoria, to say the least. So these are just something that you want to pay close attention to. Now, look at lumber. Lumber saw some weakness today. We gapped up, and then we rolled over on some strong volume. So is this the start of a potential move? I mean, this is a parabolic rise, just insane move in the price of lumber. It'd be healthy for this to fall, just for consumer prices to come back to earth a little bit here. But we'll monitor this. This could be the early start, but we did see something similar like that before, and it recovered very quickly. So, I mean, geez, holy moly, like 1, 2, 3, 4, 5, 6, 7, 8 days in the continuous contract, just completely vertical. At some point, gravity sets in. So let's monitor that. Another thing to really keep an eye on here is that rising 10-year yield, which is right here in blue. And then you see the 30-year in black. We saw a move up today. And when you look at the weekly time frame, we're still in this flagging formation. I tell you what, if this breaks out of that flag, that could be very bad for tech. Tech is a big weighting on the S&P 500, as already stated. And that means that if we do start breaking out of these levels, I mean, at some point, debt's going to matter. But then two, tech, if it continues to see weakness and continues to roll over, that is not a good. That's not good for the S&P 500. It's going to be very hard for this broad market indices to perform with that kind of stuff happening. As far as the Bitcoin and S&P 500, there's a little thing that we noticed here where sometimes when Bitcoin peaks and then and heads lower, 5 days to 6 days to 7 days, ranging, you can see the S&P 500 shortly there follows. So you get a peak in Bitcoin, a few days later, rolls over, peak in Bitcoin, a few days, the S&P 500 rolls over, peak in Bitcoin. We continued still, we saw a little tiny dip, but we still put up to all-time highs as this still pulled down. And we're seeing some weakness, which we'll cover the Bitcoin chart here soon. But this could, it could just be a little bit of a lag time. And by all means, the S&P 500 and other indices are definitely due for a healthy correction. So at the end of this video, we're going to kind of determine where that could be and prepare ourselves for if that was actually the case. The whole month so far, me personally, I've been looking for long setups. I knew coming into the month of May that it's typically a weekend performing from a seasonality perspective, okay? And so far, we saw it move up and then we saw it recover or head right back down today. So it's still technically, from a technical standpoint, nothing's broken yet. There's just some warning signs. When we look at the VIX came up to this area of resistance, so we're right up in this range, right at around 20. But remember, and then support right down here. But remember, from a 30-minute perspective, we now have a gap below us, so that's the immediate risk to see the S&P 500 continue to push higher. But we do have two gaps above us from 24 to the 26 range, and those are the areas where you'd want to consider potentially hedging long or finding some more long positions if we can come fill those gaps up there. That would make sense to me. Let's hop into the indices really quick. Daily time frame for the S&P 500. We've still been riding this resistance line up here on weakening momentum and a weakening RSI. Still, though, technical standpoint, we're above the 20-day, we're above the 50, above the 100, above the 200, all in bullish context. If a correction takes place, where can we potentially be prepared to go long? Well, a healthy correction, in my opinion, would be right around that 4,000, right around to the 100-day moving average, to just a little bit higher. This kind of zone right in here at the bottom where you can see this support here. So that's kind of where my eye will be if we see some continued selling, but still, we're still in a very bullish trade. The SPY from the daily perspective, you can see here, just been struggling to go anywhere for quite some time. Today's candles do not look all that healthy. You can see we gapped up and then completely embodied this range candle. So this is not the greatest looking, but we need some more, continuation to the downside to have anything confirmed. And there is some support right around here at 416 that we can eyeball. And you can see here on the 30-minute time frame for the SPY, we have slightly that support here at 416, which we have mentioned, which was the neckline of this little head and shoulders, inverse head and shoulders, and we have support down here at 412. Please take note that the 30-minute RSI is moving into that oversold territory, which could result in some bounces here too as well. The last thing I want to call out is just the divergence between the percent of stocks above the 50-day moving average is starting to play hold here. Doesn't mean that it can't correct, but we did see a high to lower highs where we had a high to higher highs, very similar to what we saw here in early 2020. Dow Jones, look at the daily time frame. Really all I want to point out here is one, we're in bullish context. Two, that is one heck of a reversal type candle. So we'll continue to monitor that. It needs to see continuation and follow through to be a reversal candle, but it did come up into this area of resistance and then got rejected. Same things going on the transports. The transports we talked about on the weekly recap. It has a nice reversal type candle. That to me makes sense because from a weekly perspective, this RSI was, we haven't seen the RSI this high of a reading for the last 20 plus years. And every time that we've seen it, it sometimes goes a little bit higher, but then reverses. So, it's something to just be mindful of and pay attention to. Weekly perspective, I wanted to just call out that we did come in to this area of resistance measured back from here in 2019, and it did get rejected as we are in overbought territory. It's time to be in a healthy correction. This is why, the people that are very aware and are looking at these charts, very smart technicians and as well as, professionals, when we see these big gap ups, people are typically selling into that strength because it extends an overextended reading to even more. So you just got to be very tactical in this environment. Another thing I want to point out here is this chart I haven't brought up for a while, but I have been noticing that the utilities have been diverging from the other components that make up the DGA. The DGA is comprised of the Dow Jones Composite Index is comprised of the industrials, the transports, and utilities. And they have to kind of move hand in hand to see the DJA to continue to press up. But what we've been seeing here since, the middle of April, which is not that long to be diverging, but we've seen a negative divergence. The price has been diverging, and as you can see, we're seeing some strength come into utilities, which could help fix that divergence that's been taking place. So something that I noticed, something I want to point out. NASDAQ, very weak candle. Notice how we closed right into the 50-day moving average. This is a big red candle. Sometimes we get rubber band moves, so be mindful of that. But, big red candle, increasing volume, means we can just see more selling pressure. I do believe that we have some support right around this 315 to 320 range as far as that gap goes. And we have this gap right below us too as well. So this little zone could act as an area of support. So we'll continue to monitor that. Semiconductors, I wanted to point out from a weekly perspective, it's only Monday, so we have a lot of time, but just take note, on the weekly recap, we were talking about how this looked pretty decent because we, recovered from the 20 EMA. Take note that we're below it right now. Still have a lot of time in the week, but not a good start, obviously. Russell 2000, not looking healthy at all. At all. This could be very well could be an advanced head and shoulder pattern. As you can see, the head here and some shoulders building out. We are now below the 20-day. We're below the 50, and we saw a pretty big red candle as RSI headed south, as well as the price percent oscillator too. But keep in mind, there's still support right here at this neckline, right at around 215. And on the monthly time frame, that's exactly where the 5 EMA is too. So it could be a very good opportunity to hedge long. And the reason why I say that is because it's a very easy way to manage risk, and it makes sense from a risk versus reward standpoint. This does look like an advanced topping pattern, but it needs to be confirmed, clearly needs to be confirmed. So it's something to just put on high alert, but it's nothing to get completely freaked out about quite yet, because we haven't seen anything from a key technical perspective break. Weekly perspective, so far though, this trend line is not looking all too hot as the price action now fell below the 13 EMA. This looked pretty bullish, and if we saw continued strength in the financials, that could have helped propel. However, if yields continue to rise, there's also a big portion of the IWM that have overextended valuations. It's a broad market indices, so financials in and of themselves aren't going to be enough to hold up something like this. Now, if we start cracking down through this trend line, there is some support within this range, but just take note that if we were to crack through that neckline, crack through that monthly 5 EMA, this would be just a solid area of support down here. And I've been keeping a close eye on that for quite some time, but we still have obviously a long way down to even really consider that. Financials, the BKX, we had this little rising wedge, but we got a big gap up. And then look what happened. We sold onto that strength, and it was just progressively moving further and further down, not in oversold territory, which tells me, especially looking at some of the financials, like in the Patreon group, we took some profits on Citigroup. JPM was looking very good as well. However, now we have some big daily reversal type candles, so I'll talk to the Patreon group here shortly about that. Commodities, let's go into that. Gold has been looking very strong. However, the only warning sign that I saw was this area of resistance matching with this one, and then we have the confluence with the 200-day moving average. After this big move, I'd imagine it's time to take a little bit of a break, but who's to say that it's going to be right now? So we'll continue to monitor this as it's running into that area of resistance. So it's more of just kind of be cautious. All right, let's take a look at the price of silver. Silver today peaked out at around a high of $28 flat, got rejected and headed lower. Still very bullish looking overall. However, this does look like somewhat of a little bit of a reversal type candle. I think if we continue to see the dollar show weakness, that could be a good sign to see continued strength in the precious metals. But as it stands right now, it doesn't look like the greatest entry point in silver, just because we are pulling up into this previous area of resistance. So it is one of those times where, we see a lot of things moving into resistance, a lot of things moving into oversold territories. So as I see it right now, it's it'd be fine if it takes a little breather right here, but we want to stay above 2650, above the 50-day moving average, above the 200-day. That'd be pretty healthy, or even potentially just a little pullback and then continue a press higher. Now, Bitcoin is getting a little bit scary today. It's really these last couple of weeks, it's been struggling to break out to these all-time highs. And, one thing to mention, this looks just like the IWM, so I wanted to put that little arc here because this could also be, somewhat of an advanced topping pattern as it's slowly rolling over. So it really does need to start recovering here very shortly in order to, correct this phase, this consolidation it could be. We had this rising wedge here. We cracked down through it. It's forming another rising wedge. We're right below the 50-day moving average. And, there's no saying if we can't break down through this. I mean, we can go to 37,000, 40,000 rather quickly in these currencies, cryptos. So just be mindful of that, be aware of that. And also note that if we start breaking past this period of consolidation, I think that would be a little bit more healthier, obviously. But as it stands right now, it's a little bit of a red flag as momentum has been dying, both from a relative RSI perspective and the price percent oscillator perspective too as well. As far as WTIC goes, crude oil, we came down to around 64, still holding as support, closed at 65. It looks like it's consolidating here. Will say I'm starting to notice significantly higher prices at the gas tank, at the gas pump. I do drive a hybrid, so I don't use gas and I don't really go anywhere all too often, but I was shocked to see that, it was clear where I live, it was clear above $4. And my wife has to use premium in her tank, and it's like it was like 440 or 450 or something crazy like that, maybe even higher. I can't remember. Let's look at the dollar. The dollar came down, slightly today, and then showed a little bit of strength, a little bit of an indecision candle. Or is it going to bounce from here? Is it not? It's very undecided. But what I want to point out here, other than the fact that they had this negative correlation and it's been doing this, is that we are still positive on the year. That's that gray dashed line right here. So if we start cracking through that, I think then obviously it's a pretty bearish sign as we're in bearish context, but from 2021 perspective, we're still slightly up on the year. All right, conclusion time. Let's wrap this all together. We are seeing the sell signals trigger, right? We're seeing strength in defensive names. We are seeing these blow-off tops happen in various commodities. Corn, right? We saw weakness today. By the way, another note on corn, which I haven't mentioned yet. If you follow the DeMark sequential theories or indicators, Thomas did mention today too as well, which he is very good at using the DeMark indicators. He noticed that it was a sell sequential 13 signal. Something like that. I can't remember. I'm not good with DeMark or use them. But that is a pretty accurate reading, and it came in on the price of corn. And corn's been obviously vertical, lumber's been vertical, and everything from a commodity standpoint has been just really skyrocketing. So one has to wonder if we see continued weakness in lumber and other commodities, can that affect the broad markets? We're seeing the sell signals take place. We're seeing 10 years into 30 years starting to press up higher as there was a poor jobs report, which a lot of people are interpreting this as, okay, the Fed's going to continue its policy, higher unemployment. They're going to continue printing. They're going to continue doing what they've been doing, with no signs of, thinking about tapering. And now we're starting to see, once again, after those jobs reports came out, the 10-year boom up, 30-year boom up. So we're living in this time currently right now where you must be very, 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 very careful. So long-winded answer to this conclusion is, as I'm going to this vacation, is I took profits on a lot of trades today. I moved stop losses up on a lot of trades, and I'm going to be very, very picky on any certain trades that I enter up for the week to come until I see maybe some strength re-enter into the market. But as I see tech continuing to see weakness in names like Tesla, NIO, various other ones, this is just not a good sign as of right now. And another thing too is the ARK funds. We saw that little bounce that we called out in previous videos got rejected by its symmetrical triangle pattern. But on a bigger note, like on recent news, the Bill Hoying, I can't pronounce his last name, but the Archegos fund that blew up apparently helped funded Kathy Wood's first 4 ETFs, and that's she talked about that and was super thankful at this gathering that they were at. I don't know. It's just interesting, just weird stuff, So really, I'm ranting on right now, but this is not the environment to just say, heck with that. I'm just trying to make as much as I can right now. Do not do that. this is the time to protect capital, protect your wealth. This is the time to be very careful, as it has been recently with some frustrating trading days as we're getting these gaps, and then they kind of just do nothing, and then they gap again, or they gap and then they sell off. So difficult time, difficult trading environment. I noticed one of the market wizards today, Mark, he backed off, said he was all in cash. I know plenty of other people doing the same thing. So this is the time to just be very diligent in how you manage your risk. All right, everybody, that's all I got for you. Talk to you later.